me, Faith. Thank you for having me on.
Me too. I always love it when you're on. Hey everybody, thanks for joining us today. We're going to give it about 30 seconds or so for people to filter in. You have joined the last week in mortgage today, so we'll get started in just a little bit here.
Hi.
I forgot to confirm your title.
So it changes.
The story there.
I feel like it does change, sometimes daily. VP of Operations Strategy this week. And actually, it's been that for the last couple of weeks, so we may be onto something here. But VP of Operations Strategy.
That's what I had. I just wanted to confirm. Oh my goodness. Hey everyone, thanks for joining us. This is the last week in mortgage today. I'm Faith Howard Mooney, the SVP of Member Engagement here at the Mortgage Collaborative. Donielle Geiser has agreed to join me, which I'm always so happy when she does. She is the VP of Ops Strategy, as we were just discussing at Lord.com.
Yes.
Thanks for doing this, Donielle.
Yeah, no, thank you for having me. I know I said this to you directly, but I love being a part of these calls, these conversations, and getting to be on them when I'm normally on the other side of it. So thank you.
Yeah.
Thank you for having me.
You can come back anytime you want. You just need to let us know. Do you want
You
to
say
give us?
that now.
I always do. I always do. You want to just give everybody so that they, have a good understanding. You are now at lower.com, Thrive, join lower.com. You want to just give us a little update on what's going
Sure.
on? Yeah.
Yeah. So Thrive Mortgage, which I've been at for, gosh, almost 10 years. So we actually did merge with Lower, which is a large IMB out of the Ohio area. And so joined forces, very like-minded companies coming together really to build something that is, as we like to think about it, a little bit disruptive in the industry, but really trying to push forward innovation. It is definitely a tech-forward company, which has been really exciting to be a part of, to learn about. A lot of acronyms that I'm still learning, like RPA and OCR and all of the big fun names. But it's been really fun to see what's possible in terms of the tech world. And so that's been a big initiative for us coming into the Lower environment, joining forces, and really, with the intention of being a top 5 lender here in the very near future. So we've got big goals, we've got big dreams, and we've got big tech behind it. So it makes it really fun to challenge the limits and create something new. And so that's been our big push and our big initiative, and really the drive of bringing Thrive, which was so efficient, so I'm going to say it operationally excellent, and bring it in with the Lower environment to really join forces and create something that we think can hopefully serve a lot of the communities that we're in currently, and hopefully expand that footprint to more communities. So
yeah, fantastic. Fantastic. We're going to start by talking about something that I know you were having a little bit of FOMO about this last week. And it's right up that alley of technology and some of the things that are going on. So this past week, FHFA had their second ever technology sprint. The first one was last year. This one was focused on AI. And we were really fortunate. So was Lower, I guess. You had somebody, you want to give a shout out to the person that you had that was tech sprint?
Absolutely. So our director of mortgage technology, so that's all of our mortgage tech systems, our POS, our LOS, our bots, all of the above. Brittany Oates, she actually went and represented on one of the teams, represented Lower. I know Melissa was there as well. And so I definitely, when you say I had FOMO, I definitely did. I was live streaming the whole thing. Really wanted to be involved and be there, but it was just exciting to watch some of the ideas that came forward. And I think that's, I know last week on the rundown with Melissa and Rob, Christy was on and just talking about, the use of AI, and that it can be a little intimidating. It's definitely a unknown, explored kind of frontier, if you will, that I think more and more people are getting involved in. But, she said it, I think, so poignantly, is that we just have to start. We know regulation is not going to keep up with the innovation that we're moving forward in, but if you don't start, Now you're going to be behind the 8 ball. And so that's really critical. And just to see some of the ideas that were pushed forward through just, imagination of what is possible. And I think that's something that we definitely talk about at Lower almost every day of, what can we do? What is possible? How do we make this better? How do we just get better ourselves than yesterday? That was really what this tech sprint was all about in terms of technology and really focusing that forward. So it was neat to see everything from, even just being able to take pictures of an appraisal or a property and then put the like ADA compliant restrictions and guidelines on top of that. And what do we need to do to make this home compliant, to meet the guidelines? And I mean, just rent positive type of, getting somebody from a rental property in a rental status into a home buying status and walking them through that entire process through technology, through apps. Obviously, my favorite part was a lot of the operational efficiencies that we can add in and build into our systems and our current workflows with technology. I think we spent the better part of 2020 talking about bots, talking about, how to build that. We did. I mean, it was every conference, every meeting, every webinar, and that the bots aren't replacing our humans. But at the same point in time, how do we take that technology and now couple it with AI, machine learning, OCR, and expand it even more, not just to create efficiencies and accuracy with the data that we're pushing forward, but to grow and help and educate our consumers, our borrowers. And so it was really neat to see some of the things that were brought forward.
Yeah, and I think people have gotten more comfortable with the goal of using some of it really is to also enhance your employees' work lives as well and have them working on higher functioning activities where, they're maybe more engaged with the borrower and some of those types of things versus doing very, very manual processes and some of those things. For those of you that did not tune into it, it is out there. You can go back and stream it and watch it. So look for the FHFA technology sprint. They looked at customer experience, assessing creditworthiness, operations, and risk management and compliance. Those were the categories that they looked at. So Melissa happened to be on Team Open Angels. And theirs was the best consumer experience idea. I have to say that it's TMC's second time having a TMC person in the technology who presented that won an award.
Yeah.
Pretty proud of that happening. There were the Team AI astronauts, which I thought was fun and funny. Team Bear and Team Arsenal. So, and they all talked about those 4 different categories. So if you didn't have a chance to see it, I would encourage you to go out and just watch it or listen to it in the background of what you're doing to see kind of like what's coming down the path and what people are talking about. We also at our conference, for those of you that are going to be in Denver, we are going to have a session there where Melissa will be discussing kind of what happened at the sprint and then also giving an update on what happened from last year's sprint that has kind of come into play that has begun to gain adoption. And so if you're in Denver, you'll probably want to check that one out in our agenda. And for those of you that are on the call, we have a number of people on the call with us today. If you want to give a shout out to the people in your companies, we typically have a number of them, but this year I did not see the list of who was part of it. If you had somebody from your company that joined the technology sprint, would love to give them a shout out on here because I think it's a pretty cool thing to be involved with, to be asked to join.
Well, and I just love that FHFA is really putting that forward, and trying to get in front of it, and creating what is possible. And, one of the big things I know that the team that Brittany was on from Lower, one of the big things that they were focused on is, just that AI. So like Chat GPT, that's all open, information and it's not protected. And so that is one of the big things that we've been discussing at Lower just as a company. If we're going to use some of these technologies, which you would be silly not to and just left in the dust, but how do you protect your customer information? How do you keep that all internal and not allowing it to go, completely external where anybody can search for it? Because mean, that's the fastest way to lose your reputation. 100%. Yeah. Oh, you can find all of our customer data out on the web. So, just making sure that we're thinking through all of those processes. But again, I think, just to even have the conversation at that level of FHFA of what is possible, what can we do? It's very forward thinking especially for a government organization. And I know I was very appreciative of it in looking, because these are things that we deal with on a daily basis and that we're going to have to embrace as an industry in order to continue to advance our offerings and our service to our communities. And so it was really nice to see that being embraced at the GSE type level and moving it forward. So
For sure.
cool.
And to hear that they're doing something with last year's, it's like you always
Right.
wonder after you have something that happens, it's like, okay, that was fabulous. Those were great ideas. What happened to those?
Yeah.
And is anybody acting on those? So I think good to see that as well. And of course, great to see, some of the people involved, the people that are involved in the tech sprint are people from companies within TMC. They're not just all of the really large players in the industry necessarily,
Exactly.
but the feedback that's being shared comes from a lot of different angles as well, which I think gives a better idea always,
Yep.
pretty much.
100%, that collective voice, because I mean, I know as an IMB, some of the things that depositories are concerned about doesn't necessarily impact me. But then on the flip side, I don't want, the IMB voice just to be, the large players that everybody knows from advertising on TV. That's, I like to think of us as more of a community lender, so to speak, even though we are a large IMB. But how do we sell this in our streets? How do we actually take it forward and help Joe down the street, my neighbor, versus just push button get mortgage type of situation for anybody and everybody? But making it accessible, being able to reach more people, help more people, educate and communicate with the industry. I mean, I think that the thought of I need 20% down to buy a home, unfortunately, that's still a mindset that's out in the universe. And it's like, no, no,
Yeah,
no, wait. So these tools, I think, are a great opportunity to reach those folks and drive more business into realizing home ownership dreams.
it is.
Hopefully.
I always think too, in interacting with all of the lender members in our network too. Sometimes when you're, a huge player and you have a large budget, you don't think as creatively as the people that don't, right?
Right.
They have to come up, with additional solutions that you just can't just go out and necessarily just pay for all of them without knowing if you're going to have ROI. So I think there's some creative thought process in there too when maybe you don't have the largest budget. One of the things that I saw that I thought we would talk about for a little while today in the news is related to home equity
Yeah.
transactions. And, home equity has doubled in 7 years. I guess that's not really surprising with what we've seen with home prices shooting up, people staying in their homes right now,
Yes.
some people because of,
Where do you
the
go?
interest
How do you
rate.
afford to go somewhere?
Yeah. Yeah. And well, not wanting to leave the twos, right? The
Right.
twos or maybe even threes. Yeah, so it was interesting. I just love picking out little sayings that I've seen. Homes are the nation's piggy bank was the one from this week. And it's like,
Like
oh, I've never really thought about it that way, but I'm sure there are a lot of people that do think about it that way. So, and from early 2012, which of course would be recovery from the Great Recession, home equity has quadrupled,
mhm.
um, a low of 8.2 trillion. So crazy. But then what is happening is how do people tap into
Yeah.
that equity, right?
Right.
Uh,
That's
so
a
like,
big topic, especially when you have that swing of interest rates, over the last 4 years from 2 to 7. That's a hard sell of, yeah, let's refinance, let's do that. And so that's actually been a tactic that we've deployed at Lower of really, helping our teams or helping our teams to really get into those conversations. And I think it's really been a transition from being that transactional loan officer of, hey, let's do a deal, let's put this together, let's get you in the house, you know, et cetera, to really being more of a financial advisor and hopefully creating that customer for life. You know, that is a big thing, because you know there's going to be a refi boom at some point. Rates will come down, maybe not to the twos, but you know, we could see with some rate cuts over the next 12 months, you know, a point drop maybe. And so we know that people are going to truly, you know, want to refi just based on that, especially if they've purchased a home in the last 12 to 24 months, you know, take advantage of that 6% rate. But for those people that are stuck in the, I say stuck, happily stuck in the twos and threes, you know, they don't want to give up that rate. Yeah, exactly. And so I was actually looking at some data from, oh, I can't even remember where I pulled it from, but it was a little bit older, a couple weeks older, from like the week of the 19th, you know, and just looking at refinances, especially on the Govy side, I think have gone up applications for probably about 4%, you know, just increasing those applications. Um, Conventional, you know, we're seeing HELOCs 40% up week over week. And so it's really interesting to see that. And one of the tactics that, you know, we've shared with our sales teams is that, you know, don't just look at it as I'm changing your rate on your first, you know, mortgage. You're losing this 2%. Look at it as, let's take the full financial picture of our borrowers and how can we help them. You know, if you're paying 22, 25% in credit card debt, is that really helping you? And what we've actually found is when you go through that exercise of truly looking at the full package, full liabilities, full, you know, goals and everything of our borrowers, we can actually save them sometimes thousands of dollars a month by taking a cash out refinance. Which sounds crazy, but you're going from a 22% credit card interest rate down to a, you know, maybe a 7% mortgage, and being able to consolidate that debt. And so overall, it actually does make a huge impact. But for those that are, you know, particularly rate adverse, which I completely understand myself, I'm sitting at a 2.25% interest rate and I don't want to touch it. You know, home equity lines or even home equity loans, great option, you know, to have. And so if you're not talking about that and offering that to your borrowers, at least at a bare minimum, you're certainly doing them a disservice in terms of overall financial picture and creating that trust and that relationship. So find those outlets to help your communities and to help your borrowers. And like I said, it really takes you from a transactional loan officer or transactional team to really building that, you know, rapport, and being that financial advisor for your borrowers to come back to, because they're going to come back to somebody. Might as well be you, right?
Right. It's funny because when I, you know, read some of these things and am prepping for this, I think I look at it maybe from a different lens, or at least I've started to, because you said earlier that the consumer still thinks that you have to have 20% down. Our we're in this every day. So for us, you know, it all makes sense. You know, you kind of understand what the path of your mortgage is going to be and those types of things. But the general population is what they know about mortgages a lot of times is what they've seen on the news or they've read in articles. And one of the things that this article said is avoid a cash out refinance. And my gut reaction was, well, not always, because it's such a personal situation that, you know, credit card debt is the highest it's ever been in the United States. And you said it earlier, you know, you could potentially, that was my initial reaction to this. It's like, what about those people who have thousands of dollars in credit card debt? Because people do.
Absolutely.
Does it make sense to be paying $1,000, $2,000 a month in credit card debt, but yet have a 2.5% interest rate?
Right. And that's what we're seeing a lot of. You know, people, again, to your point, they're not moving, so they're not taking that cash out from the sale, those net proceeds, which makes sense. I mean, people like to age in place, and especially right now with inventory, as you know, dicey as it is, it's hard to find that next property, and especially, you know, paying what you're already paying. You know, do you increase that monthly payment just to move into a smaller house? That's a hard concept, I think, for a lot of people, but to that point, when you sit down and you really do the numbers with somebody and you take the time, which is a differentiator in this market right now, take the time to sit down and ask those questions with your borrowers. Does this make sense? Because a lot of the time when they see the numbers on the paper, yes, that 7% is a little bit of a gut punch initially, but when you look at it and you say, wow, I can really save $3,300 a month just by consolidating, my credit card debt into a lower interest rate, it's a giant impact on people's lives. And that's where we see the most benefit coming through. Now, is that always the right option? No. It might be that home equity line of credit. And we've seen just here at Lower a huge increase in people applying for home equity lines. And I mean, it's a no-brainer because the equity is there. And to your point, carrying all of the credit card debt, I mean, cost of goods, we see that just continuing to increase and rise over time.
Yeah.
So how do we get our borrowers into a better position, whether it's, today, tomorrow, or even 6 years from now that they want to purchase that downsized home? Let's put them in a better position to do that.
Yeah.
Have
Yeah.
those conversations, even though it feels weird, and saying, I'm going to take you from a 2 to a 7% interest rate, stick with me. Let me tell you why. Yeah, exactly. But wait, there's more. That gimmick.
Have the conversation though. I mean, you're not obligated to have the conversation and see what the difference is. And if it's not now, maybe it's 3 months from now or 6 months from now or whatever it is. Our Mark Renault is gonna put you on the spot. He asked, when precisely are these rates coming down? I'm tired of being wrong all the time. What's your opinion?
Mark, I'll take that offline with you. I'll give you a call after this. No, I don't know. I really don't think it's gonna, personally, and I'll say this on record, I don't know that we're gonna see a great impact from any kind of rate cuts this year because it's already kind of baked in, I think, to our rates. But fingers, toes, legs, everything crossed, we'll see it hopefully next year. So
yeah,
I'm an optimist.
Yeah, I think a lot of people would probably agree with that. The other thing is if you're somebody that's purchasing, rates coming down, how much does that really impact? You can't find a house to buy.
Right.
I mean,
exactly.
if with affordability being what what it is. Now, maybe it helps some people move, and then that opens up other housing for them. I guess that's what, I would hope, would happen with some of that. Housing migration is something that happened a lot during the pandemic, and there were a number of places. You're in California. I think California, a bunch of people moved away from California when that happened because they could be remote with, some obviously maybe coming back, realizing the grass isn't always greener. Some, their companies requiring them to come back into the office.
Exactly.
What have you seen related to that?
Yeah, so I was actually just talking about this with my internal team earlier this week. Well, I guess that would be Monday, it's just Tuesday, but earlier this week, we were looking at, and we constantly monitor the market. We're big in construction, lending, and so one of the things that we are seeing, especially in the South, is homes are actually starting to sit on the market for a little bit longer than they have been in the previous years, upwards of 30 to 45 days. Also, the big thing that we're seeing is contracts canceling after the inspection period or during that inspection period. And so a lot of it is truly, buyers are picky. I mean, and they have the opportunity to be picky right now. And it's not, I'm going to go to the next house picky. It's, I'm just not going to pull the trigger right now picky. And so that's absolutely, I think, a shift in what we've seen previous years, or at least as long as I've been in the industry. When there's plenty of homes to pick from and choose from, and I can go, open house, open house, open house, straight down, the row in a neighborhood. Yes, buyers are going to be picky, and they can, but now it's truly, well, this house doesn't work. It's okay. I'm going to stay where I am, and I'm not going to pull the trigger and purchase anything. So I'm taking myself truly out of the market. And I think that's what we're seeing a lot of, especially in Texas. Florida is another big one, which, I mean, makes sense too with all of the cost of insurance that we're seeing these days, which is sometimes higher than your principal and interest payment just to get homeowners insurance, depending on where you are. All of these factors truly play in, especially to first-time home buyers. And I think that's who's really suffering the most in this market environment that we're in. High interest rates, housing, whether it's been upgraded or even just, maintained, that's an option that they have. And so we are seeing primarily in the South, just housing dwellings sitting for, a longer period of time. But it goes back to that great migration that you were talking about, is people are trying to move out of those areas a lot of the time where they moved into in the pandemic. And so it's an interesting time right now, and a lot of it does have to do with construction too. Because when you saw that great, to your point, California to Texas, that was a huge move in the pandemic that we saw. And it makes sense because Texas doesn't have state income tax. California, not so cheap. And so, there was a great push on our builders to increase inventory, build for the masses. They're all here, they're coming more, they're staying. And now the reverse has happened. And so we are seeing a little bit of a slowdown in terms of new construction in those areas because they have inventory stacked up, ready to go. So it's been different to say the least. It's a new problem. Yeah. Yeah, exactly.
And not following what we would perceive as a typical trend that we were kind of accustomed to before. It seems like all of the answers that we had before are, oh, just wait, another 60 days, 90 days, and it's going to turn back. That's what the cycle is. This isn't like what traditionally has happened in our industry prior. You kind of hit on people not moving. One of the things that I ran across this week was an article, and it was called "Why Are Young Rich Americans Ditching House Ownership?" Mm-hmm. And I just thought, okay, I have to read this because it's interesting. And initially, of course, gut reaction was, well, that's because there are no homes to buy, right?
Not always.
Mm-hmm. Yeah, not the case, particularly in this demographic. The number of young millionaires is like doubling. Mm-hmm. Those smart young people that came in behind us have found a way to be in jobs that allow them to be in that financial position. But this article was about, even if they have a 7-digit annual income, most of them are kind of sitting back and watching things right now and not going out and buying a new home. And it typically because of soaring housing prices. So they're kind of hanging on with the thought process that housing costs are going to come down. And that will be a more opportune time frame to buy. Or I don't know if you thought this, but I know I've thought this in the recent past. Have you ever, like walked into a house or had an impression of a house or a development that maybe you wanted to be in, and you walk in and you see it, it's a beautiful home and everything, and then you look at the price point to it and it's like, I would never buy a house, not even this house, for that. I mean, my original house that I bought in the Twin Cities is owned by my ex-husband still. And we built the house a long time ago for under $100,000. It's now worth almost $4 million.
Wow.
And no way in the world I would be buying a 30-year-old house in that neighborhood. It's a beautiful home.
Sure.
But not worth $400,000.
Yeah. Well, and I think you also see a lot of these. I know that there's a couple of people that I follow on YouTube and Instagram where they talk about, home ownership costs. Like, oh, I bought this home and I'm so excited. It's my first home. And then our water heater broke. And then I've got to repair the fence. And then I've got to do that. So I think more people are actually also talking about just the legitimate cost of home ownership and maintenance. Exactly. And I think that's something too that's maybe the consumer is a little bit more educated on. I know when we purchased our first home, it was like, yay, we've got a house. It's exciting, in our 20s. And then the reality set in of like, oh, wait.
Blows. You have no electricity and it costs,
right.
dollars to fix it.
Yeah, and we see that in the numbers too, you know, on the backside of loans and the defaults. You know, that something, one thing, you know, you spend all of your hard-earned money getting into the home with closing costs and down payment and insurance, and then you're just like one appliance away from defaulting on your loan because you've spent all of your money. You don't have that nest egg anymore. And so, you know, you need a new washer and dryer or something like that. And now all of a sudden, you know, 5 grand later, you're like, well, where do I get the money from? So anyway, it's absolutely, I think, an education piece. I think it's something that is truly, you know, concerning and broadening that. But yes, seeing it 100% of the time. And that's, I think, a lot of just being picky, going back to that picky buyer that we have right now. They don't have to. They don't have to buy a home. They don't have to make that choice and can continue to save up for when they do find the right home, when costs come down, when insurance gets sorted out and interest rates kind of hopefully normalize back to where we're all a little more comfortable with them. So,
Well, yeah, and you know, maybe that our viewpoint needs to just change, adjust a little bit, and that maybe they're not being picky, they're being super smart.
yeah, they
They
probably
they
have more money in the bank than we do.
exactly.
Yep.
Exactly. Okay, so I have to share something with you. Someone's otter bot is on with us. And the very first takeaway from the meeting is provide a call to Mark Renaud to discuss interest rate predictions offline. By Donielle.
See, Mark, it's going to happen.
Thanks for pointing
Amazing.
that out, Ira. I think that is
Oh,
hysterical.
thanks, Ira. Don't worry, I'll call him.
We're at any time today. It always
Oh,
goes by
so
so
fast.
quick, and we never have time to truly personally get caught up, but we
Yeah,
will
we
okay,
will.
soon.
In Denver.
In
Denver.
Denver, we need to plan to do that. I appreciate you always doing this with me. You truly can come anytime you want to just
Oh,
have
thank you,
a
Faith.
conversation. Thank you, everybody who was in the audience today and joined us. Come back next Tuesday for another session of the Last Week in Mortgage Today. Appreciate you all. Thanks.
Bye.